Every dollar in your savings account is a vote for a poorer future. Most people think saving money is the most responsible financial decision they can make. The debate between security and growth is a battle between our primal brain and the cold math of a system designed to punish caution. Where do you stand? By the end of this, you might realize your safe choice is the riskiest one of all. The argument for saving is simple. It's powerful. It's about control. Imagine two people, both earning the same salary. One lives paycheck to paycheck, a single unexpected bill away from disaster. The other has 6 months of living expenses tucked away in a savings account. A $5,000 car repair hits both of them. For the first person, it's a catastrophe. It means high-interest credit card debt, panic, and sleepless nights. For the second person, it's an annoyance. A simple transfer. A problem solved. That is the power of liquidity. It's the ability to absorb life's shocks without derailing your entire life. This safety net has profound psychological benefits. It lowers your daily stress. It gives you the freedom to walk away from a toxic job, knowing you have a buffer to find a new one. It gives you bargaining power. When you have cash, you have options. You can negotiate from a position of strength. This feeling of security is tangible. It's the firm ground beneath your feet in a world of uncertainty. The discipline of putting money aside every month builds character. It's a vote for your future self, a declaration that you are in control of your destiny. That sounds like the definition of financial responsibility. But there's a problem. That fortress you've built has a saboteur inside the walls, silently dismantling the foundation stone by stone. That saboteur is inflation. It's the invisible tax on your caution. While your money sits in a savings account, its purchasing power is constantly eroding. A 2% inflation rate seems small, negligible, but over time it's a force of nature. At that rate, your money loses nearly a quarter of its value in a decade. In 35 years, its purchasing power is cut in half. The $100,000 you saved with decades of discipline now buys what $50,000 used to. The number in your account is the same. The reality it represents has been gutted. Holding cash is like trying to walk up a downward escalator. You have to run just to stay in the same place. This is where the investor's argument begins. The goal is to get off the downward escalator and onto one, going up. The goal is to make your money work for you, creating more money while you sleep. This happens through the power of compounding. Consider $10,000. If you put it in a high-yield savings account earning 1%, after 30 years, you'll have about $13,500. After inflation, you've actually lost significant buying power. Now, take that same $10,000 and invest it in a broad market index fund, averaging a historical 7% annual return. In 30 years, that $10,000 becomes more than $76,000. That's the difference. It's the difference between a retirement filled with anxiety and one filled with freedom. The saver's money is dying a slow death. The investor's money is alive and multiplying. The math is undeniable. And yet, for many people, the thought of investing is terrifying. Numbers on a chart are abstract. The feeling of watching your life savings drop 20% in a month during a market crash is visceral. It feels like a punch to the gut. Who can possibly stomach that kind of risk, especially when the money represents years of hard work and sacrifice? It seems like a gamble reserved for the wealthy, for people who can afford to lose. This fear is real. It's valid, but it's also based on a misunderstanding of risk. Your savings account is not a zero-risk proposition. It is a 100% probability of slow, steady loss. The risk is just quiet. It's guaranteed. It's the certainty that your money will be worth less next year than it is today. Investing, on the other hand, involves volatility risk. The value goes up and it goes down. A paper loss is a temporary drop in value. It only becomes a real loss if you panic and sell at the bottom. The risk is visible, it's scary, and it is probabilistic, not certain. The key to navigating this is your time horizon. Money you need in the next 1 to 3 years has no place in the stock market. That money is for emergencies, for a down payment, for life's immediate needs. Its job is to be stable and accessible. That's what a savings account is for. But money you won't need for 10, 20 or 30 years, that money has a different job. Its job is to grow. For long-term goals, the risk of short-term market volatility is small compared to the certain corrosive damage of long-term inflation. Over any given 10-year period in history, the stock market has overwhelmingly gone up. Someone who invested a lump sum in an S&P 500 index fund on the absolute worst day of 2007, right before the global financial crisis, would have seen their portfolio crash by more than 50%. But if they did nothing, if they simply held on, they would have been back to even by 2012. By 2017, their initial investment would have more than doubled. Meanwhile, the person who kept their money in cash lost purchasing power every single one of those years. The question is which risk you are more equipped to handle, the sharp temporary pain of volatility or the slow, permanent erosion of your wealth. This suggests a hybrid approach. It's a system of buckets. Your money is not a single pile. It's a team of workers with different jobs. The first bucket is your emergency fund. This is pure cash, sitting in a high-yield savings account. It's your fortress. This is for the true emergencies, the job loss, the medical crisis, the blown transmission. It's your peace of mind, liquid and ready. The second bucket is for your medium-term goals. A house down payment in 5 years. A new car. This money can be in something safer than stocks but with better returns than cash, like short-term bonds or certificates of deposit. Its job is preservation with a little bit of growth. The third bucket is for the long haul. This is your retirement. This is for your 50, 60, 70-year-old self. This is the money that goes into the market. Its only job is to grow as much as possible over the next several decades. This framework transforms the debate. The question is no longer, should I save or invest? It's how much should I save before I invest? What is the correct size for that emergency fund? The common advice is 3 to 6 months of essential living expenses. 3 months is lean. It forces you to be efficient, but it leaves little room for error. A prolonged job search could drain it completely. 6 months is the standard for a reason. It provides a robust cushion for most of life's curveballs. But what about 12 months? Or more? This is where financial prudence can curdle into financial paralysis. At 12 months of cash, the opportunity cost becomes immense. Every dollar beyond the 6-month mark sitting in cash is a soldier sitting in the barracks instead of fighting for your future financial freedom. It's a dollar that is actively losing value. This is the point where saving stops being a tool for security and starts being a drag on your future. Defining these buckets seems logical. It's a clear, rational system, and yet millions of people who have a perfectly adequate emergency fund continue to stockpile cash. They have 12, 18, even 24 months of expenses sitting in accounts, earning next to nothing. Why? What drives this behavior when the math is so clearly against it? The answer is buried deep in our psychology, in the ancient wiring of the human brain. We are governed by something called loss aversion. Decades of research have shown that the psychological pain of losing a dollar is roughly twice as powerful as the pleasure of gaining a dollar. A market downturn that cuts your portfolio by $10,000 hurts, in a measurable neurological way, twice as much as a market upswing that adds $10,000 feels good. Your brain is wired to avoid loss at all costs. The slow, invisible loss of inflation doesn't trigger this alarm. It happens below the threshold of our perception. But the sharp, vivid drop of a stock market correction screams danger. We are biologically programmed to react to the visible threat, even if the invisible one is more certain, and ultimately more damaging. There is also the power of tangibility. You can log into your banking app and see the exact number of dollars you have. It feels real. It feels solid. A stock portfolio is an abstraction. It's a line on a graph representing a fractional ownership of companies you'll never visit, run by people you'll never meet. Our minds evolved to trust the concrete over the abstract. For 99% of human history, the key to survival was hoarding tangible resources. The person with the biggest pile of grain, the most salted meat, the sturdiest tools survived the winter. Your brain is still running that software. Your savings account feels like a full granary. An index fund feels like a vague promise of a future harvest that might be wiped out by a storm. Finally, it comes down to a feeling of control. The act of saving is an act of agency. You earn the money, you chose to put it aside. You can access it whenever you want. You are in the driver's seat. Investing feels like a surrender of control. You give your money to the vast, chaotic, unpredictable ocean of the market and hope for the best. We are so desperate for a sense of control over our lives that we will willingly trade enormous potential future wealth for the small, comforting illusion of being in charge right now. We choose to stay in a car that is slowly but predictably rolling downhill, because at least we have our hands on the wheel. So we are caught in a fundamental conflict. One path offers a comforting, tangible sense of security, but charges you a silent, guaranteed tax called inflation. The other path offers a chance at real life-altering growth, but demands you stomach gut-wrenching volatility and surrender your illusion of control. The prudent saver and the ambitious investor are both trying to build a secure future. They just have different definitions of security. Is security having cash on hand for tomorrow's crisis, or is it having enough compounding assets to fund the last 30 years of your life? The line between a responsible safety net and a self-destructive hoard of cash is different for everyone. It's a calculation of risk, time, and temperament. So where do you draw the line between a safety net for today and a launchpad for tomorrow? How much of your future are you willing to pay for the feeling of safety right now?